Hi, this is the second part of the lecture on hedging currency risk and commodity price risk. And in this half of the lecture, this particular video lecture, we're going to focus then on hedging foreign exchange or currency risk with forward and futures contracts. We'll also look at using other financial futures to hedge things like market risk in portfolios. And we'll look at the exposure that a firm can have to foreign exchange risk, to market risk, and so on. And finally, we'll just talk briefly about some speculative spread strategies that one can use using futures. But just to remind ourselves that there are some points about hedging that we sort of need to keep in mind. One is that most hedging strategies are not static strategies. They're not hedge and forget strategies. A lot of hedging strategies are dynamic strategies, which means you have to monitor the situation and adjust, shall we say, your hedging portfolio or hedging strategy as conditions change. We noted at the beginning of the course that there are many risk factors that can't be hedged, and so you should be cognizant of that. We also said that hedging reduces variability, not just the downside. And so this is important that when you do get into a hedging strategy, that you make sure that whoever is your superior out there knows that the hedge reduces both the upside and the downside. And so if things work against you, then the hedge looks great. But if it turns out that the risk factor would have worked to your favor, then the hedge sometimes ends up looking rather foolish. But again, as long as when you get into the hedge strategy, you and anyone above you, they know that you are giving up the potential of upside in order to protect the downside. And that's what hedging does. Also, hedging is not always risk reducing. We did mention that sometimes a firm might be naturally hedged. The classic case of this is a refinery. The input to the refinery is crude oil and the output, say, is gasoline. And the difference between those two, between crude oil prices and the gasoline prices, the so-called crack spread, that tends to stay fairly constant. That is, whenever crude oil prices go up, gasoline prices will tend to go up with a lag effect. But when crude oil prices come down, gasoline prices will tend to come down. But that spread itself tends to stay fairly constant. And that spread is the margin, okay, which determines the profit then of the refinery. Now, if you hedge just the input side, what happens then is that you keep this input side fairly stable, but the output side is going up and down. And so what you end up doing is you end up actually creating more variability in the profits than less variability. And so we just need to know that in some situations when you are naturally hedged, there is no need to go and hedge one side, shall we say, of the hedge, one side of it. And if you do, you'll end up then increasing risk rather than reducing risk. Lastly, and this is also very important, when you get into the futures market, we know there's always the possibility for margin calls. And as long as you maintain the hedge to its maturity, in most cases then whatever margin calls you receive during the life of the hedge, you will recover it all back on the other end of the hedge, on the spot end of the hedge and so on. But you have to be able to meet all the margin calls. You cannot close out the hedge prematurely. When this happens, like in the case of a company called Metallgesellschaft, then you end up realizing losses, and at the same time you end up becoming unhedged, in an unhedged position, which essentially is a double whammy. So when you get into the hedge, remember your firm, or if you're an individual, you have to have deep enough pockets to meet all the margin call requirements. With that said, then let's go into looking at more on hedging. So far, what we had looked at was what was called a 1-to-1 hedge ratio. That is, for every unit you had in the spot market, whether it was a long hedge, a short hedge, or a cross hedge, for every unit you had in the spot market, then you are going to enter into 1 unit in the futures market to hedge. Typically, a one-to-one hedge ratio is not optimal, especially when you are cross-hedged. Okay, when you are cross-hedged, then the hedge ratio, that is the amount of futures positions, the size of the futures position per unit, shall we say, of a spot position that you take becomes critical. And so in order to determine then what the optimal hedge ratio is, you sort of have to have in mind what is the objective behind hedging. And there are different objectives. For instance, if you are hedging market risk, the hedge is actually to reduce market risk, not to reduce the variability in your portfolio's returns. In that case, you're into what's called a price-sensitive hedge. You are hedging against the shall we say, the price of the market. In most cases, though, the objective behind hedging is to reduce the variability, to reduce the variance. And so the hedge ratio, the optimal hedge ratio in those cases then would be the minimum variance hedge ratio. How do you determine the minimum variance hedge ratio? Well, there's some mathematics behind it. And of course, these slides are already up on Blackboard. So here's a look at the mathematics behind it. You set up essentially the hedge itself, and the hedge itself. Let me expand this here a bit. So the hedge itself is actually then this is the hedge itself, and this we know is the spot position you have. Minus then, because you will take an opposite in the futures market, minus the futures position you have. So if you have n number of futures units for the hedge, and this n would be your hedge ratio, then that essentially is the hedge itself. And the change in the hedge you can calculate, and using the change in the hedge you can calculate what the variance is. And then you solve for the optimal variance, the minimum variance, the usual mathematical way. You take the first derivative, set it equal to 0, and solve for that. What you end up getting then is you end up getting that the optimal hedge ratio is then the correlation. So let's see if we can expand this out. No. You end up getting that the optimal hedge ratio is the correlation then between these two, spot price and the futures price, times then the ratio between the standard deviation of futures price of spot price changes and the standard deviation of the futures price changes here. So let me see if I can blow this up a little bit here so that we can sort of see this better. So there is the formula then for the optimal hedge ratio, the ratio between the standard deviation here of the spot price, standard deviation of the futures price, times then the correlation between the two. Note that this hedge ratio is the number of units in the futures market that you will need per unit in the spot market. To transform that hedge ratio now into the number of actual futures contracts you will need, that's what happens down here. So the number of actual futures contracts you will need then is that hedge ratio times your spot position, the size of your spot position, divided by the futures contract size itself. And here's an example then that's fairly standard. Suppose an airline company will buy 1 million gallons of jet fuel in 3 months and wants to hedge this using futures contracts on heating oil. So we know the airline company is using heating oil as opposed to futures contracts on gasoline or some other futures contracts, because heating oil has the highest correlation then with jet fuel. The jet fuel prices and heating oil prices then have the highest correlation of all underlyings in the futures market. The standard deviation has been determined to be 0.032 or 3.2%. This is standard deviation of jet fuel prices. The standard deviation of the futures price has been determined to be 4%. And the correlation between jet fuel prices and futures prices then is 0.8. each futures contract has a contract size then of 42 gallons. So in order to find the optimal hedge ratio, we use the formula that we had before, the correlation times then the ratio between the standard deviation of spot prices and the standard deviation of futures prices. And so we get that the optimal hedge ratio is 0.64. That is, for every 1 gallon you have in the spot market, you will need 0.64 gallons in the futures market to hedge. And to translate this 0.64 gallons into number of futures contracts that you will need, we then take 0.64 times your spot position, which is the 1 million gallons of fuel that you want here, then divided by the futures contract size, which is 42,000. So this rounds up to 15.2 contracts. This is actually 15.2 contracts exactly, and it rounds down to 15 contracts. Now there's a debate as to whether you should round off, that is to the nearest whole number, or whether you should round down. The debate then is one as to if you round off, then in some cases you'll be rounding up, and if you round up, you end up being overhedged in the futures market in that situation. We won't focus too much on that debate. It's a philosophical sort of academic argument. For now, we're just going to focus on rounding off. You round to the nearest whole number, and we'll leave it at that. So that is the using futures contracts on commodities with the optimal hedge ratio. Now, to hedge foreign exchange risk, then usually, unless you are in a proxy hedge with foreign exchange risk, you won't be cross-hedged. That is, if you're hedging the pound sterling, you can find futures contracts exactly on the pound sterling and so on. But the case then is how do you set up the hedge in terms of the optimal number of contracts to use. And this, of course, means that if you're not using an exact number of contracts, and in the futures market, this happens a lot because the position you are hedging may not exactly match the contract size of the futures contracts. In this case, you'll end up with some of your spot position being unhedged. And so here's an example of how to sort of deal with that, or how to analyze then a hedge on the pound sterling when you end up in a situation where some of the spot position you're trying to hedge is unhedged. So in this example, and this example is example 10.5 from the textbook, which you can find, I believe, on page 361 and 362. So here, an American car dealer is planning to essentially buy 20 British cars. Each car costs £35,000, and they're planning to do this in November. It's currently July, and they're planning to buy the cars then in November. The total amount then of pound sterling they will need is 20 times 35, which is 700,000 pounds sterling that they will need. And they'll need this in November. There are no November futures contracts on the pound sterling, so the car dealer decides to go into December futures contracts. Recall that we said you would always enter into futures contracts with the maturity after the spot position that you are trying to hedge, and as close to it as possible, but after. If you can get it exactly on that day, you would. It's always safer to go a little bit after, because sometimes you may end up closing out your spot position unexpectedly. And then if you picked a particular day, then you may end up being unhedged for a while. So the December futures exchange rate is $1.2780 per pound. The current spot exchange rate in July is $1.319 per pound. So these are the prices then in July. The spot price for the pound sterling in July, the futures price for the pound sterling in July. The futures contract has a size of 62,500 pounds sterling per contract. And the car dealer enters into the hedge in July, and in November, when the car dealer then needs to purchase the pound sterling, the spot price then is $1.442 dollars per pound, and the December futures price for the pound then is 1.4375. So let's analyze this then. Let's set this up here. This is sort of the timeline that we are going to be using, where maybe I should move this down. Down a bit over here. Very good. And so this is the timeline we'll be using in July. This is the spot price or spot exchange rate for the pound sterling, indirect quotes as usual, and this is the futures price, and this comes from the example. And in November, this is the spot price for pound sterling, and this is the December futures price. Now in December, we really don't need these prices because our analysis ends here in November. And so there are three questions then that are to be asked, and this, the first question would be how many futures contracts are needed then to hedge the foreign exchange risk that this car dealer faces? The second question is, in November, what would be the effective price paid for the pound sterling? That is, when the car dealer enters into futures contracts to hedge the pound sterling, based on the hedge itself, what would be the effective price paid for the pound sterling? Now, some of the amount, the sum of the 700,000 will be unhedged, and so the car dealer will have to pay that balance that's unhedged, the spot price of it. And so the third question then is, how much in total does the car dealer pay for the 700,000 pounds sterling in dollars? So let's take a look then at answering these questions. We'll start then with question 1. How many futures contracts are needed to hedge the foreign exchange risk? So the answer to that is clearly the number of contracts forgive my handwriting, is equal then to our spot position divided by contract size right, and of course all of this should be multiplied by the correlation between the two. But because this is not a cross hedge, the correlation is actually just 1.0. So really it's 1.0 times all of this. Okay. And what we know is that this is 700,000 divided by 62,500. And that then is equal to 11.2. which will round off to be approximately equal to 11 contracts. Okay. So that answers the first question. How many contracts are needed? The second question then, and the handwriting looks awful, I know. The second question then is, what is the effective price paid for the pound? Now, in order to answer this question, we will need to calculate then what B0 is and what BT. Just as a matter of procedure, it's always useful just to calculate those at first. What is the basis at time 0 and what is the basis at time t? So we know the formula then for basis is that the basis B0 at time 0 is equal to the spot price at time 0 minus the futures price at time 0. And so that then is equal to 1.3190 minus 1.2780. Okay. That then is equal to 0.0041. Maybe I should try writing that a little better. So try writing that a little better here. Okay, that looks a little better. And then we can find out what BT is at November. BT is then equal to ST minus FT. This is the formula. And that then is equal to 1.4420 minus 1.4375. That's equal then to 0.0045. So with this then, we ask ourselves, what is the effective price? And we know what the formula is. That is, whether it's a long hedge or a short hedge, the effective price has the same sort of formula. Still, we know then that since you're going to be buying pound sterling in the future, that this is a long hedge. And so it's still the same formula. But the effective price then is then equal to, this is the formula, F0 plus BT. And that's the formula. And we know, of course, that this is a long hedge. Okay. So with this then, our effective price then is equal to the initial futures price, which is 1.2780, plus our basis in November, which we just calculated to be 0.0045, and this then is equal to 1.2825. So that's our effective price for the pound, and that's dollars per pound sterling. Okay. So finally, we'll answer question 3. Question 3 says, then, how much in total does the car dealer pay in dollars? How much in total? Let me sort of show what the formula is going to be. I'm going to just pop up what the formula is, and then what we'll do is we will calculate out the amount. So there it is, the total amount that's paid, and let's go through the logic of this. Is the hedged amount, that is the amount of the 700,000 pounds sterling that you've hedged with the futures contracts, times the effective price you pay based on the hedge, which we just calculated, plus the unhedged amount, that is the residual. You didn't hedge all of the 700,000, so we'll have to figure out how much is unhedged. But that amount, then you're going to end up paying for those pounds at the going spot price here. So let's calculate then out what all this works out to be then. So, and our hedged amount then we know is going to be equal to our hedged amount is will be equal to the contract size 62,500, which is the contract size for pound sterling, times the amount of contracts we have, 11 contracts, and then times the effective price that we have, which is 1.2825. 0.825. I believe that's right. And then plus our unhedged amount, and the unhedged amount then is the 700,000 minus essentially what's over here, which is the contract size that's here, and that's 62,500 times 11. All of this then times the spot price, and the spot price we can see it up here. This is the spot price up here. That essentially times 1. Sorry, it's 1.42. Oh no, that's all wrong. So let's erase that. And let's see. Erase all of that there. Okay, here's our pen. And then 1.4420. Okay. And with that then, if you do the calculation, that amount is equal to 687,500. Okay. Times 1.2825, and this then is plus the balance 700,000 minus that, which should be 12,500 times 1.4420. And when you work all of that out, then you end up then with this, I think, is 8881 point, oh, sorry, 881,718.75 plus 18,025.00, and this then works out to be 899,743.75. So this is the total amount then you pay, and this of course is in dollars. And so this is the amount you pay for the 700,000 pounds sterling in the future. So if we go back now to the original slide question, if you go to table 10.5 in the textbook, you'll see then that this is the table that they have, which essentially explains what the position was in July and what happened in November. And if we sort of zoom in here, we can see then that that the total amount paid for the 20 cars, the total amount that they pay for the 20 cars then is in fact 899,743.75. Exactly what we got here, 899,743.75. So and that's sort of with foreign exchange rates. The difficulty there is not so much the cross hedging. The difficulty is in getting the number of contracts to use and then figuring out what the effective price is for those number of contracts, and then what the unhedged position is, and you multiply that by the spot rate. So the next step then is, or the next topic we'll look at is, suppose it's not foreign exchange rate you want to hedge. Suppose you want to hedge other types of risk using then financial futures. And a classic example then is using index futures to hedge out market risk. So typically a portfolio manager will have a portfolio of about 20 to 40 stocks, so a well-diversified portfolio. The portfolio manager has been very judicious in her selection of the stocks. She's done her securities analysis, And she's picked stocks that she thinks are going to do well relative to their industry, relative to their market. She's picked stocks that have so-called positive alpha. Her problem now is she might be concerned that over the next little while, the market might turn against her, and she wants to protect her positive alpha stocks from this general downward market movement or general uncertainty in the market. So she would like to reduce the market risk of her portfolio down to zero and leave then just the alpha to run. That is essentially she wants to reduce the beta of her portfolio down to zero, so to be insensitive to market movements. How does she do this? Well, the formula then that she would use is fairly similar to the formula for optimal hedge ratios. In this case, though, the formula uses the beta in some sense as the hedge ratio. And so if we sort of zoom in there on the formula, we can see that it's the number of contracts to use to hedge a portfolio is the current beta of the portfolio times essentially the portfolio size itself, which is P, divided by the futures price times then the futures contract size. So futures contracts on indices are financial futures that are only settled in cash. And the way you figure out what the cash settlement is you take the futures price, and each futures contracts on an index will have a multiplier, which is the contract size. For example, if we're going to use futures contracts on the S&P 500, then this then is from Investopedia. We can see then that futures contracts on the S&P 500 here, the contract size is the S&P 500 multiplied by 250. So that's the contract size of futures contracts on the S&P 500, and that's the multiplier. So the contract size then essentially is 250 for the S&P 500, and let's use that then for our example. So for our example here, we'll say, suppose the current futures price on the S&P 500 is $1,000. The portfolio has a portfolio size of 5 million. And the current beta of the portfolio is 1.5. The question now is, what position in the futures contract should this portfolio manager use to hedge out the market risk of this portfolio? So in order then to answer that, we'll take a clean page. Okay. And we'll use the formula that we had before. The number of contracts then to use is the beta. So what they should do is they should short. You short then, and okay, the number of contracts, which is the beta. So we said the formula is the beta times the portfolio size divided by the futures price times then the contract size in the futures market. Sorry, again, let me get rid of that. Okay. Times, I believe it was a Q with F, and that's the contract size here. And this is how much you want to short. So this is 1.5, that's our beta. The portfolio is 5 million. Okay. Then divided by, we said the current futures price for the S&P 500 is 1,000. And what we just saw is that the contract size then is 250. Yeah. So this then of course works out then to be 30 contracts then short. Okay, So that's really a simple issue here. There are times when the portfolio manager would actually like not to reduce the beta of the portfolio down to 0, but sometimes just to reduce it a bit. So down, say for instance, from 1.5 to 0.75. There are other instances where the portfolio manager might think that the market's going to move up and wants to make her portfolio more sensitive to market movements. That is, she wants to increase the beta of her portfolio. How does she do this? The formula changes a little bit, and I'll just put the formula up here. I'm not going to do any example, and I'm probably not going to test you on it in the final exam, but just so that you know what the formula would look like. Here is sort of the formula, in which case the amount of number of contracts you want to do is you want to short this number of contracts. This is the current beta of your portfolio minus then we'll call this the target beta. That's a target beta. Then of course all of this times what we had before, your portfolio size times the futures price, and then the quantity size of the futures market. So this is the formula that you would use, and this is what you would short. Note that if you want to increase the beta here, then this target beta will be bigger than your current beta. And if this is the case, then this number would be negative. And so you'd be shorting a negative amount, which means you'd actually be going long. Okay, that's that for now. The next the next thing we want to speak about then is rolling the hedge forward. So when it comes to hedging, we're saying that one thing you take into account is that you always want to have your hedge in place when your spot position matures. And so if there are no contracts that mature on exactly the day you know your spot position is going to mature, or if you're not sure when your spot position is going to mature, that is, you're not sure when you're going to be buying the commodity or buying the pound sterling or selling the commodity itself, then what you do is you go out. You don't take a futures contract exactly to that day, but instead you go out a little bit beyond beyond the, excuse me, you go a little bit beyond the day that your spot position is going to mature. So if your spot position will mature in November, you take the closest thing after November. Say you take a December futures contract. Now, there are times, of course, when you cannot do this. There are times when your spot position is so far out that you cannot find essentially any futures contracts beyond that. You can't even find futures contracts up to that maturity. So if you know you're going to be buying crude oil, say in 2.5 years or in 3 years, then what you have to do is you actually have to take out futures contracts to the longest maturity you can, and then of course when you get to that position, you essentially want to roll the futures contract over again. Let me draw a diagram to sort of show what I mean. So suppose this is the current time times 0 here, and you want to hedge all the way out to here, which is way out, 2 years, and you can only get a futures contract up to here. So you take the futures contract, say 9 months. Okay, you take the futures contract up to here, and then when you get just before it matures, you enter into another futures contract for another 9 months, say, okay, 9 months. And then just before that matures, you enter into another futures contract, okay, for another 9 months, and so on. And before that matures, and you keep doing this until you essentially get to the maturity that you want to get to. So you keep essentially rolling your hedge forward. Okay. Now, each time you do that, and Each time you do that, then you end up, shall we say, incurring an additional source of risk, which is sort of known as the rollover basis risk that happens then each time that you do that. Okay, sort of just move that back here so we can see more of what's happening. Very good. So moving along, how do you speculate using futures contracts? Well, there are various ways. I'm just going to speak about the types of people who speculate in the futures market, and then speak about different sort of spread strategies you can use to hedge using futures contracts. So the types of speculators are the same types you see in most financial markets. You have the scalpers, which are intraday traders. They trade very, very frequently, so they are high frequency. They make extremely small profits off each trade. They so-called scalp off each trade, but they trade very, very frequently. And then there are the day traders, and the day traders will hold their positions for a longer time. They sometimes will close out their positions before the end of the day. But usually they never hold a position for more than one trading day, and then they switch to a new position. And then finally, we have the position traders, which are the ones that hold their positions for a longer period of time, for weeks, months, and so on. So with speculators, you can simply speculate using what's called naked positions. So you simply go long in the futures market, or you go short in the futures market, or you can use spreads. And the spreads essentially there are two main sorts of spreads. There's what's called the intra-commodity spread. And with the intra-commodity spread, you are taking futures contracts on the same underlying commodity, but you are switching up the maturities of these. So you go long with one maturity and short with one maturity, depending on whether you think the price is going to go up or down. Okay. The inter-commodity futures spreads essentially uses futures contracts on different commodities. Now these commodities will be correlated. So for instance, you can use futures contracts on gasoline and futures contracts on heating oil. And really, you're playing then that both of them will move in the same direction, but the spread between them will get bigger or smaller. And so you'd go long in one and short in the other, depending on which one you thought was going to increase relative to the other one, or decrease relative to the other one as well. And that then is spreads. Futures contracts are also used for price discovery, and this is just sort of if you have an asset that is not traded, how do you determine what the value of that asset is? If it's a variable that is not traded in the market, how do you determine what the price of it is, what the market thinks it's worth? So for instance, if it's weather, how do you determine how much the weather is worth to farmers and so on? Well, one way you can find out what something is worth, a non-traded asset or a non-traded variable, one way you can find out what it's worth to the market then is to introduce futures contracts or other derivatives on these non-traded variables. And then the market will determine what the futures price is. And from that futures price, you can kind of infer then what the market thinks it's worth. And that's what price discovery is. It allows then the market to place a value on an asset that is not traded itself by simply introducing futures contracts on that asset. Foreign exchange risk, we have spoken about that. We had seen an example of this, and we just briefly want to speak about the different types of exposure to foreign exchange risk. And you've probably come across this then in the international finance class. There are three different types of exposure when a firm faces foreign exchange risk. One is the transactions exposure. That is, for every single commercial transaction that the firm enters into involving a foreign currency, the firm will face some risk that the value of that transaction or the cash flows from that transaction could go up or go down depending on whether the exchange rate changes. That's transactions exposure. That happens, of course, quite frequently and is fairly easy to assess. translations exposure is essentially the impact that changing foreign exchange rates will have on the consolidated financial statements of a multinational corporation. And the last one is the economic strategic exposure, or what's sometimes called the operating exposure. And this essentially is more difficult to assess, but is actually more important than the other two. And this is when foreign exchange rates change, how does that change the competitive position of the firm? How does it change the firm's value, overall value, and so on, based on projected future cash flows that might come in, based on projected future discount rates, based on projected future competitive positions. So for the transactions exposure, like we said, most firms will hedge that. The economic or operating exposure is a little more difficult to deal with. But for the transactions exposure, we just mentioned that there are different sort of timelines to it. And once again, you probably would have seen this in international finance. These are the different aspects of the exposure that a hedger or a risk manager has to be concerned about. And that is at the beginning, when an exporter, for instance, quotes a price to an importer in some foreign currency, should the exporter then decide to hedge that quoted price? Now, if the exporter waits until the importer places a firm order, the exchange rate might change, and so the value the exporter is going to get from that quote will actually have changed between the time the quote was made and the time the order is placed. So, should you hedge? Well, this is it's really up to the risk manager, depending on how certain they think that quote will turn into an order. But that aspect of the transactions exposure is called the quotation part, or the quotation exposure. And then when the importer places a firm order, the exporter can decide to hedge now or wait until they ship the goods over. Okay, and if they wait, then by the time the order is placed to the time the goods are shipped, exchange rates could change, and that part is called the backlog exposure. And finally, after the goods have been shipped and the importer settles up, then that part of the exposure then is called the billing exposure, and so on. So you should know, when it comes to foreign exchange risk, you sort of should know what determines foreign exchange rates. And these are the sort of four basic factors that determine foreign exchange rates, that contribute, shall we say, to foreign exchange risk. Okay, the PPP, or the purchasing power parity, the balance of payments from one country to the next, monetary supply and demand, including essentially the central bank's monetary policy, and of course interest rates and the international fishery effect. So if you're not sure how these determine foreign exchange rates, I suggest then you pick up your textbook on international finance and take a look then and see how they affect them. And that's really all in for this video lecture. There are a couple more slides on there, but they're really for your information only. So we'll see you again. Bye.